let's start a new chapter. In this chapter, we'll study stock and stock valuation. Now, in this chapter, we have the following topics that we need to cover. Number one, the intrinsic value of a stock versus the market price of stock. Number two, the discounted cash flow model. Number three, the corporate valuation model. And then number four, the multiple methods. How do we use multiples to calculate stock price? Let's look at our first topic, the intrinsic value of stock versus the market price of stock. What is the intrinsic value of stock? The intrinsic value of a stock is the stock price that a stock ought to have. In the equilibrium or in the efficient market, then the market price should be the same as the intrinsic value of the stock. However, in reality, a lot of the times, especially on the short-term basis, the market is not efficient. And we have information asymmetry in the market, so that's part of the reason that the market is inefficient. So in the efficient market, with information asymmetry, the outside investors have perceived risk of the stock, and then based on the perceived risk, they come up with the perceived value of the stock. So the perceived value of the stock is the market price of the stock. However, because of information asymmetry, these perceived risk, perceived value often deviate from the true risk and the true value of the stock. So the true value is the intrinsic value of the stock. So we say only in efficient market, when market is in equilibrium, then market price is the same as the intrinsic value of the stock. In reality, when market is not efficient and often the time we have information asymmetry, then the market price often deviates from the intrinsic value of the stock. How do we value a stock? Well, a stock is also a financial asset. So based on the future cash flows that the financial asset is going to generate, we can discount these future cash flows, find their present values, add them up to get the intrinsic value of any financial asset. And this can also apply to a common stock. So what are the cash flows a common stock can generate in the future? Well, a common stock can generate two types of the cash flows. One, if the stock pays dividend, then dividend is one type of the cash flows that the stock can generate. Number two, if at some point we sell the stock, then we realize capital gains. So capital gains is another type of the cash flows that a common stock can generate. So if somehow we can get the dividends and the cash flows of the common stock, we can discount them, find their present values, add them up, and that will give us the intrinsic value of a common stock. So valuing a common stock is the same as valuing any financial asset. You will have to discount the future cash flows, find their present values, and then add up the present values of the future cash flows. You will get the intrinsic value of that financial asset. Now, the second topic in this chapter is the discounted cash flow model. So early on, I mentioned common stock can generate two types of cash flows. One, dividends. Second, capital gains. If we hold on to a stock forever, we never sell it, then the only type of cash flow the stock can generate is dividend. If somehow we know the dividend that the company is going to pay, if we can calculate the present value of these dividends, then adding up these present values, that will give us the intrinsic value of a stock. So this is the discounted dividend model. Also, we call it discounted cash flow model. And the intrinsic value of a stock is the sum of the present values of the future dividends that the company is going to pay. To be able to use the discounted cash flow model, we have to make some assumptions. And these are the two assumptions we have to make. Number one, we have to assume the company pays dividend. Number two, the dividend the company pays will have to grow at a constant rate. Now, without these two assumptions, it will be mathematically impossible to calculate the present values of the future dividends. And it will be mathematically impossible to use the discounted cash flow model. The second assumption we mentioned, that we assume the company pays a dividend and that dividend grows at a constant rate. Now, how can a company grow? Well, in reality, in general, the dividend grows as the earnings of the company grow. Now, how does a company grow? Well, there are two ways a company can grow. One, it can get outside financing, an infusion of outside capital, either through debt financing or outside equity financing. If the company get infusion of capital, they can use the capital to reinvest, to grow and then expand. And that's one way for the company to grow. Now, the second way the company grows is through internal growth. So the management retains some of its earnings every year and use the retained earnings for reinvestment. And then the reinvestment result in future growth of the earnings. And if the company pays consistent dividend, then when earnings grows, the dividend will grow as well. The outside financing is hard to predict because we never know when the company is going to use outside debt financing or equity financing. It's not a reliable prediction. However, the internal growth can be very predictable. Therefore, to use the discounted cash flow model, we have to rely on the predictable internal growth and use the predictable internal growth to use the discounted cash flow model. Now, how do we calculate the internal growth rate? Well, the formula for internal growth rate is the return on equity multiplied by 1 minus the dividend payout ratio. Now, let's explain this formula. Now, what is the dividend payout ratio? Well, dividend payout ratio is the dividend in dollars divided by earnings per shares in dollars. So, per dollar that the company generate in earnings per share, how much does the company pay out as the dividend? So 1 minus the dividend payout ratio will give you per dollar the earnings per share the company generate, how much does the company keep as retained earnings for reinvestment. This 1 minus dividend payout ratio, we also call it the profit retention ratio. So the profit retention ratio times the amount of profit, which is the ROE, then that should give us the growth rate of the dividend and also the growth rate of the earnings per share. So when we can assume that the company pays dividend and the dividend grows at a constant rate, we can use our discounted cash flow model to calculate the intrinsic value of the stock. And when we have these two assumptions, that a company pays dividend, then the dividend grows at a constant rate, we can apply the discounted cash flow model. Actually, the discounted cash flow model converges to a simplified form, and that is the intrinsic value of the stock equals the dividend that we can expect next year divided by the required rate of return, which is R, minus the growth rate, which is G. And the dividend we can expect next year, we call it the D1. So the intrinsic value of the stock, P0, equals the dividend we can expect next year, which is D1, divided by R minus G. R is the required rate of return. G is the constant growth rate of the dividend. And sometimes we also write down the formula in a different form. So the intrinsic value of the stock, P0, equals D0, which is the dividend that the company just paid last year, multiplied by 1 plus the growth rate. So D0 times 1 plus G, that is the same as D1 because the dividend, D's, grow at a constant rate, G. So D1 is also D0 times 1 plus the growth rate. And then the intrinsic value of the stock, P0, is D0 times 1 plus growth rate divided by R minus G. R is the required rate of return. G is the growth rate again. And all the dividend, as long as we know one dividend, we can derive all the other dividend because the dividend grows at a constant rate. So in this formula, we see that D1 can be D0 times 1 plus the growth rate. Now, D2 can be D1 times 1 plus the growth rate. And that can also be D0 times 1 plus the growth rate squared. And any dividend or dividend at any year, Dn is D0 times 1 plus the growth rate reset to the power of n. Now, in the discounted dividend model, we also see the required rate of return in the denominator. Now, how do we get the required rate of return? Theoretically, we can calculate the required rate of return or a nominal interest rate as the sum of these different components. So any nominal interest rate, including the required rate of return of this common stock, should be the real risk-free rate plus inflation premium plus default risk premium plus liquidity risk premium plus maturity risk premium. So if it is common stock, then it should be exposed to all these different risk factors. So its required rate of return should include all these different components. In practice, we actually use the capital asset pricing model and other models to quantify the required rate of return. Now, let's see a numerical example. So, if a stock just paid $1 in dividend at the end of last year and is expected to pay a cash dividend in the future, and these dividends are expected to grow at a constant rate of 6%, and the required rate of return is 10%. So, what is the intrinsic value of this common stock? Now, based on the discounted cash flow model, we need to calculate D1. So D1 is D0 times 1 plus the growth rate. The growth rate is 6% in this example. And D0, the dividend the company just paid at the end of last year, is $1. So D1 is $1 times 1 plus 6%. And that should be $1.06. Now, the intrinsic value of the stock, P0, is $1.06. D1 divided by the required rate of return, R, minus the growth rate, G. And the required rate of return is given 10%. The growth rate is also given 6% constant. So the denominator is 10% minus 6%. That will be 4%. Now, the intrinsic value of the stock P0 is therefore $1.06 divided by 4%. And that should give us $26.50. So the intrinsic value of this common stock is $26.50. In this example, we're able to use the discounted cash flow model because the model satisfied the two assumptions. One, the company pays dividend. Second, the company grows at this dividend at a constant rate, 6%. So that's why we can apply the constant growth model or the discounted dividend model to come up with the intrinsic value of the stock, which is $26.50. Notice here, even in the model, we use D0, but D0 should never be part of the cash flow. So if you are the investor who's going to buy the stock, the next dividend you can expect is D1. So the dividend the company is going to pay next year, not D0, because that D0, the dividend, is already paid to the current shareholder, not to the potential investor of the stock. So as a potential investor of the stock, you can only expect a dividend starting at D1 and including all the coming dividends, but not including D0. But why do we still observe D0 in the model? Because D1 can be expressed as the product of D0 and the 1 plus the growth rate. And this is only because the dividend grows at a constant rate. So from D0, we derive D1. This not because D0 is part of the cash flow, but only because we use D0 to derive D1. And this is why we observe D0 in the model, but D0 should never be part of the cash flow. Now, sometimes the growth rate of the dividend changes. So in this case, we have what we call the supernormal growth stock. Let's look at the following example of the supernormal growth stock. So suppose we have a common stock just paid $1 dividend at the end of last year, and it's going to pay the dividend in the future. The dividends are expected to grow at 20% for the first 3 years. And then the dividend growth will slow down to a constant 6% forever. And then the investors require rate of return is 10%. What is the intrinsic value of this common stock? Now, notice here the dividend growth rate changed. So for the first 3 years, the growth rate of the dividend is 20%. And then it settles down to a much slower rate of 6% afterwards. So in this case, we cannot directly apply the constant growth model. We have to make some modifications. So first, we will have to calculate the dividend in the first 4 years. And the first 3 years, the dividend growth rate is 20%. And with D0 being $1, we can calculate the dividend at the end of the first year, the dividend at the end of the second year, and the dividend at the end of the third year. So the dividend at the end of the first year, D1, it will be D0 $1 times 1 plus 20%, which is the growth rate. So that should give us $1.20 as D1. Now, D2, the dividend at the end of year 2 is going to be $1.20 D1 times 1 plus 20%. And that should give us $1.44 as the second year's dividend. Now, D3 should be D2 grow at 20%. So $1.44 times 1 plus 20%. And that should give us $1.73, almost 73 cents. So 1.728 to be exact as D3. Now, D4, notice in the fourth year, the dividend is not 20% anymore. It's going to be a much slower growth rate at 6%. So D4, it will be D3 1.728 times 1 plus 6%. Now, That should give us $1.83 or 1.832 to be more exact as D4. And we can also go ahead find D5, D6, so on. But we don't need to find D5 and D6 and all the other Ds because after year 3, we can apply the constant growth model or the discounted cash flow model. Because after year 3, the dividend growth rate is going to settle down at 6% constant. So after year 3, we can apply the constant growth model or the discounted cash flow model. So we can calculate the value of P3, which is D4 1.832 divided by R minus G. R is the required rate of return. This is 10% in the example, and 6% is the new growth rate. So the denominator is 10% minus 6%, that'll be 4%. The numerator is D4, $1.83, 1.832. So therefore, that should give us a value of P3 at $45.80. So 45.8, that should be the value of P3. Now, some of you might ask, what is this P3 value? What does that stand for? Now, the P3 value is the present value at year 3 of all the future dividend. Now, all the future dividend include D4, D5, D6, and all the dividend after year 3. However, this P3 value does not include the dividend in year 1, year 2, and year 3. This P3 value only includes all the dividend after D4. So the P3 value is the equivalent of all the dividends after D4, including D4. Now, to get the intrinsic value of the stock, we also have to include the dividends at year 1, year 2, year 3. And also the P3 value is not a present value yet. It is a value at year 3, but it's not a present value at year 0. So we also have to discount that P3 value. Now, the intrinsic value of the stock, P0, is the present value of D1, the present value of D2, and the present value of D3, and the present value of P3. So the sum of these 4 present values. Now, the present value of D1 is 1.2. The present value of D1 is 1.2 divided by 1 plus the opportunity cost, which is the required rate of return, 10%. And that should be 1.091. And the present value of D2, 1.44, that present value is 1.44 divided by 1 plus 10% raised to the power of 2. So that should give us 1.19. Now the third dividend, 1.728, the present value of that is 1.728 divided by 1 plus 10% raised to the power of 3 because it needs to be discounted for 3 years at 10%. And that present value is 1.298. Now, P3 value, 45.8, that is also a value at year 3. So we also need to discount it for 3 years. And the present value of P3 is 45.8 divided by 1 plus 10% raised to the power of 3 as well. And that present value is 34.41. Now, the sum of these 4 present values is 37.989. And that should be the intrinsic value of this common stock, which includes the present values of D1, D2, D3, D4, and all the dividends after D4, including D4. Our next topic in this chapter is the corporate valuation model. So discounted dividend model or the discounted cash flow model assumes that the company pays dividend. Now, in reality, we know that a lot of companies don't pay dividend. So not all companies pay dividend. Now, if the company does not pay any dividend, well, we cannot apply the discounted dividend model for sure. Well, no, if the company doesn't pay any dividend, how can we value its stock? Well, if the company doesn't pay dividend, we can actually use an alternative model, which is called the corporate valuation model. And the corporate valuation model is based not on dividend, but based on free cash flows. So the company can choose not to pay any dividend and choose to pay any dividend in the future, but the companies will always have free cash flows. And the corporate valuation model is based on free cash flows. So that's why it can be preferred over the discounted dividend model because it has one less assumption than the discounted dividend model. It doesn't have to assume that the company pays dividend. All it needs is the free cash flows of the company, and all companies have free cash flows. Now, free cash flow, how is that defined? Free cash flow is the NOPAT. Also, we call it the after-tax operating income, EBIT times 1 minus the tax rate. So that's the after-tax operating income. Add the depreciation and amortization back to the after-tax operating income. That will give us the total amount of cash that is available to the investors of the company. And these investors include both the shareholders and the creditors. Now, the company will have to budget enough money for growth. And the growth is the investment in the fixed assets. So that's the capital expenditures, also called CapEx. And also, when they expand, when they purchase the additional fixed assets, they will have to either increase the inventory or they'll have to hire more staff to run the additional fixed assets, or both. So in that case, there will be a change in net operating working capital. Now, the after-tax operating income and the depreciation amortization, and that's the total amount of cash that is available to the investors of the company. Then subtract CapEx, which is the capital expenditure, and then subtract the change in net operating working capital. Now the rest of the cash is the free cash flow, is the amount of the cash flow that the investors can take out of the company without hurting its growth. So this is the definition of free cash flow. And all companies, regardless of their dividend policy, they will have free cash flow. Now, if somehow we can calculate the free cash flow's present value, add them up, and that should give us the enterprise value of the company. So that is the corporate valuation model, which calculate the enterprise value of the company. And this enterprise value is the claims that belongs to investors of the company. And these investors include not just the shareholders, but also the creditors. Because notice the first component of the free cash flow, which is EBIT times 1 minus tax rate, that's operating income after tax. And that belongs not just to the shareholders, but also to the creditors. So the enterprise value from the corporate valuation model includes both the claims of the shareholders and of the creditors. So we have to tease out the claims that belong to the creditors to come up with the stock price or the intrinsic value of the stock. So somehow if we know the creditors' claims amount, well, typically that's not too hard to know because if the company owes money, the outstanding debt, that's easily to get that number. So if somehow we can subtract the outstanding debt from the enterprise value, then the rest of the enterprise value belongs to only the shareholders. And then that will give us the intrinsic value of the stock. So let's look at a numerical example. So company A has $1 million free cash flow at the end of last year, and the free cash flows are expected to grow at 20% for the first 3 years, and then it will slow down to a constant 6%, and it will stay at 6% forever. And the weighted average cost of capital is 10%, and weighted average cost of capital is the opportunity cost of free cash flow. And because free cash flow belongs to both the shareholders and the creditors, and we have to calculate the risk for both the shareholders and the creditors to come up with the opportunity cost. And that opportunity cost of the free cash flow is the weighted average cost of capital, which is the average cost of capital for both the shareholders and the creditors. Now, suppose the weighted average cost of capital is 10%. Then also, we know that company has 1 million shares outstanding, and it also has $10 million worth of debt outstanding. So what is the intrinsic value of this company's stock? So based on the free cash flow that the company had last year, which is $1 million, and also based on the growth rate that we know of the free cash flows. So in the first 3 years, the free cash flow growth rate is 20% every year for the first 3 years, and then it slows down to 6% and stays at 6% forever. So to use the corporate valuation model, we have to make its own assumption, and that assumption is we have to know the growth rate of the free cash flow. So compared to the discounted dividend model, we need to make assumption on the growth rate of the free cash flow, but we do not have to assume the company pays dividend. So this is the advantage of the corporate valuation model over the discounted dividend model. Now, if we know the growth rate of the free cash flow is 20% in the first 3 years, then we can calculate the free cash flows at the end of year 1, the free cash flow at the end of year 2, and the free cash flow at the end of year 3. So the free cash flow at the end of year 1, that will be free cash flow at the end of year 0, 1 million times 1 plus the growth rate 20%, and that will give us 1.2 million. So that will be $1,200,000 as the free cash flow at the end of year 1. Now, the free cash flow at the end of year 2, it will be 1.2 million times 1 plus 20%. So that should give us 1.44 million or $1,440,000. Now, the free cash flow at the end of year 3 will be 1.44 million times 1 plus 20% growth rate again, and that will be 1.728 million or $1,728,000. Now, in year 4, the growth rate of the free cash flow slows down to 6%. Therefore, the free cash flow at the end of year 4, it will be 1.728 million times 1 plus 6%, which is the new growth rate. And that should give us the free cash flow at the end of year 4 as 1.83168 million or $1,831,680. So that will be our free cash flow 4. Now, we can also go ahead to calculate free cash flow at the end of year 5 or free cash flow at any other year, but we don't need to because after year 3, then the free cash flow grows at a constant rate at 6%. So we can apply the constant growth model here again. Now, to apply the constant growth model here, we get EV3, which stands for enterprise value 3. Enterprise value at the end of year 3 will be free cash flow at the end of year 4, which is $1,831,680 divided by the weighted average cost of capital, which is the opportunity cost of free cash flow, in this case 10%, minus the growth rate. In this case, it will be 6%. Now, that enterprise value 3, it will be $45,792,000. So that will be the equivalent of all the free cash flows after year 3. So free cash flow year 4, free cash flow year 5, and all the other free cash flows after year 3. And the equivalent of them is a value at year 3, then that value is 45,792,000. Now, the enterprise value at year 3 has not included the free cash flow at the end of year 1, and the free cash flow at the end of year 2, and free cash flow at the end of year 3 yet. So we will have to calculate an enterprise value which include these 3 free cash flows. So the enterprise value at year 0, it will be the present value of free cash flow 1, free cash flow 2, free cash flow 3, and also the enterprise value 3, which is the equivalent of free cash flow year 4 or all the free cash flows after year 3. So that enterprise value year 0, it will be 1.2 million, which is the first free cash flow, divided by 1 plus 10%. That will be the present value of the free cash flow 1. So $1,090,909. That's the present value of 1.2 million, the first free cash flow. Now the second free cash flow, 1.44 million, and that needs to be discounted at 10% for 2 years. So 1.44 million divided by 1 plus 10%, raise that to the power of 2, and that should give us the present value of the free cash flow 2, and that should be $1,190,083. Now the third free cash flow, 1.728 million, that needs to be discounted at 10% for 3 years. So that present value is $1,298,272. And then the enterprise value 3, 45,792,000, that also needs to be discounted at 10% for 3 years. And that present value is $34,404,207. So enterprise value at year 0 is the sum of these 4 present values. So enterprise value year 0 is $37,983,471. And notice that enterprise value at year 0 is the claims of both shareholders and also the creditors. So somehow we need to subtract the creditor's claim from this enterprise value to get the shareholders' equity. Now, if we know the company has outstanding debt of $10 million, then subtract that 10 million from the enterprise value. So we have $37,983,471 minus the $10 million. That will give us the shareholders' value, which is $27,983,471. And suppose the company has 1 million shares outstanding, then 27,983,471 divided by 1 million. Then per share wise, the intrinsic value is $27.98. Our last topic in this chapter is the multiple methods for valuation of the stock. So multiple methods is not as accurate as the discounted dividend model or corporate valuation model. But multiple methods gave us a quick and dirty way to calculate the valuation of the stock. Now, what is the multiple methods for valuation? Well, we have to use comparable companies' valuation multiples and the target company's key statistics to come up with the valuation of the stock of the target company. So the popular valuation multiple methods include using the P ratio and also the enterprise value divided by the EBITDA ratio. And here, let's see one example using the P ratio. Now, suppose company A is planning on an IPO. So company A, before the IPO, it reports a $10 earnings per share of last year. Now, a comparable company of company A is company B, who's already publicly listed company. And the company B IPO'd 3 years ago. So company B is a pretty established company and it's also in the same industry sector of company A. Now, company B's P ratio is 50 times. And this is based on company B's earnings per share last year, which is $4 per share, and the company B's current market price, which is $200. So the P ratio is 200 divided by 4, that's 50 times. And how do we use the company B's, the comparable company's multiple, to come up with a fair valuation of company A? Well, company B has already been a publicly traded company for 3 years, so its valuation is pretty established. And if the P ratio of company B is 50 times, then we can assume that at some point after A is publicly listed, when it becomes established, its P ratio or the valuation of A should be around the same P ratio, about 50 times. So given company A's reported earnings per share last year, which is $10 per share, then we can use the multiples of company B, the comparable company's multiples, 50 times the P ratio, multiplied by the earnings per share of company A, and that should give us a $500 valuation of company A's stock price. And using multiples for valuation is very flexible and popular because for some IPO companies, since it's small and it can be new, it hasn't generated any profits yet. So therefore, it's hard to use the corporate valuation model. It's hard to use the discount dividend model if it doesn't have any earnings. So in that case, we can be very creative, use the multiples of the comparable companies. So for example, let's say if it's a technology company, if the technology company is a cell phone app, and the company hasn't generated any profits yet, so it doesn't have any positive earnings per share, then that way, well, we cannot use PE ratios. We cannot use the discounted dividend model, right? We cannot use the corporate valuation model. We probably can use the corporate valuation model. But we can probably be creative, use the multiples. For example, the price to subscription ratio. So if a comparable company has subscriptions and has a market price of its stock, so use the market price of the stock divided by the subscription number of the apps for the comparable companies, and hopefully this price to subscription ratio will be also applicable to the new company who's doing IPO now. So use that price to subscription ratio and multiply by the current subscription of this company who's going to IPO. That way, we can get a quick and dirty valuation of the new company's stock price. To summarize, in this chapter, we studied the stock and the valuation of stock. We covered 4 major topics: the intrinsic value of a stock versus the market price of the stock. Also, we call it the perceived price or perceived value of a stock. Number 2, we talk about the discounted dividend model, also called the discounted cash flow model. And then number 3, we talk about corporate valuation model. This is when the company does not issue any dividend, so we cannot base on dividend, but we based our valuation on cash flows. Now, number four, we talk about using the multiple methods to value a stock. Thank you.